Hello everyone, welcome to this chapter overview video where we'll be taking a look at chapter 8, which is all about receivables. Our learning objectives for this chapter are, we're going to look at receivables using the allowance method, how to estimate bad debts using different methods, and accounting for notes receivable. We're not going to actually take a look at ratios in this video because there's an awful lot of material here. Accounts receivable are a little bit complicated, so we're going to spend our time on the part that is the most complicated. There is information in your guided notes if you're in my class regarding the ratios. All right, so generally speaking, we classify receivables as accounts receivable, notes receivable, and other receivables. So you should be familiar with accounts receivable. Those are amounts that customers owe us because we provided them with goods or services, but they have not yet paid us, right? And notes receivable also can be from customers, or a note receivable can be that someone owes the company money that the company loaned to them. So the company loaned someone money and they are going to pay them back with some interest. Other receivables could be things like interest receivable, or say the company is getting an income tax refund and they have an income tax receivable, refund receivable, something like that. So anything that's not accounts receivable or notes receivable that the company is going to be getting in the future would be classified as an other receivable. Now let's talk about recording uncollectible accounts. So that's one of the things that really makes accounts receivable a little bit tricky. Companies that have a lot of accounts receivable, they know that not all of their receivables are going to be collected. All of their customers are not going to pay them. Why? Because remember, when a company issues credit to another company, so it says, okay, you can buy inventory on account and owe us money, they look at the company's credit rating and they decide whether or not the company is creditworthy. The company is not going to issue credit only to the top companies with the best credit, because otherwise they're going to lose out on a whole lot of sales for companies in the middle, right? So companies know that some of their customers will not pay them, and they accept that as an expense of doing business because they gain a lot more sales from it. So as a result of the fact that all of our receivables will not be collected, we don't want to show them at 100% of their face value. So say you have $100,000 of receivables, but you know you're only going to collect, say, 95,000 of them. Well, you can't show 100,000 on your balance sheet if you know you're not going to get that amount. So we have to account for the receivables that the company knows it will not collect. All right, it's going to be involving some estimates along the way. All right, so we have a new account called the allowance for bad debts. This account is set up to bring our accounts receivable down to the amount that we expect to collect. The amount of the allowance is the amount that the company estimates of their receivables that they won't be collecting. And the allowance for bad debts is a contra asset account, meaning that it has a credit balance. Now, if you've been studying the same order that we've been studying, you should have been introduced to accumulated depreciation, which is another contra asset account. Accumulated depreciation reduces the depreciable assets, say building or equipment, and the allowance for bad debt reduces accounts receivable. Sometimes the allowance for bad debts is called the allowance for doubtful accounts or the allowance for uncollectible accounts, and you might hear that in other places or in some of my other videos, because it's the same term, it's the same account, but it has different words to use for the same account. All right, so at the end of the year, companies will estimate their bad debts, and we're going to talk about how they estimate it later. So they estimate their bad debts, and they make an adjusting entry to set up or to adjust their allowance to the amount that they need. They debit bad debt expense, which is an operating expense on the income statement, and they credit the allowance for bad debts, which we just talked about. That's a contra asset account. This is an estimate. It's an estimate. The final balance in the allowance is how much the company believes they will not collect. Now, if it turns out that a customer actually is not going to pay the company, and they know or they believe the customer will not pay them, they write the account off. So they're going to debit the allowance, because that's what the allowance is set up for. The allowance is set up for anything that you think, it's an estimate of what you think you're not going to collect. And then you credit accounts receivable because you don't have the receivable anymore. It's gone away, right? We're not going to collect that money from the customer. Say the customer went bankrupt, right? And they're telling us they're not going to pay us. Now, sometimes a company will write off an account and then the customer pays anyway. So in that case, two entries have to be made. In the first case, they reverse the write-off and reestablish the receivable. This is the exact opposite of the entry that we just made for the write-off. We put it back into receivables. We put it back into the allowance. And then we record the collection as usual. Debit the cash to increase it and credit accounts receivable. All right, so now, we were right here. Remember we debited cash and credit accounts receivable. Now let's talk about where that number comes from, that estimate. There are three different ways of coming up with this answer. One is called the percent of sales method, which is also the income statement method. Then we have the percent of receivables and the aging of receivables, and those are both balance sheet methods. So by way of reminder, let me go back a second. This journal entry is an adjusting entry. If you remember from adjusting entries, every adjusting entry affects one income statement account and one balance sheet account. So here, our income statement account is bad debt expense, and our balance sheet account is allowance for bad debts. So the income statement method focuses on this part of the adjustment, the bad debt expense, whereas the balance sheet methods focus on the allowance. All right, so let's take a look at these methods. Remember, all three methods, your goal is find the amount for this journal entry. All right, we're going to be debiting bad debt expense. We're going to credit allowance for bad debts for all of these. The question we're answering is for how much. Now, with the percent of sales method, remember we're focusing on the expense part. Your bad debt expense is equal to the company's net credit sales for the period times a percentage. Now, what that percentage is will be different for different companies. It is based on their past history. This method ignores the balance in the allowance, which you'll see that doesn't happen later on. So let's look at an example. Let's say that Valhalla Company estimates its bad debt expense is 1% of its credit sales. The current period sales were $150,000. So the amount of the adjusting entry at the end of the year is going to be, remember, it's net credit sales, which are $150,000 times 1%, which gives us $1,500. So the amount of the entry is $1,500. Remember, always the same entry. We're going to debit bad debt expense, credit the allowance for bad debts for the $1,500. Now, the percent of receivables and aging of receivables, the two methods are very similar. The only difference is percent of receivables involves one percentage only. Aging of receivables is a little more precise and involves a bunch of different percentages, but the procedure is exactly the same. The question you have to ask yourself is this: how much is needed in the allowance at the end of the period? This is called our target balance or our desired balance. How much does the company need in the allowance at the end of the year? Again, that's based on history. Then we have to take a look at how much is currently in the allowance. And based on those two things, we determine the amount of the adjustment. So let's look at the percent of receivables method. Before we do that, let me remind you of something, which is the things that affect our allowance for bad debts, because we're going to find that sometimes our account has a debit or a negative balance when we get to the end of the year. So remember, the allowance for bad debts is increased when the year-end adjustment is made. It is decreased when accounts are written off during the following period. So when you get to the end of the year, it's possible to have a debit balance before you make your adjustment. And that means that more accounts were written off during the year, you had more debits than you estimated. A credit balance, which is the normal balance for this account, means that less accounts were written off than had previously been estimated. There's going to be a balance, unless it's the first year of business, there's going to be a balance in your allowance before you adjust it at the end of the year, because no company could ever estimate exactly the amount that would be in the allowance, right? That would be written off for the year. So keep this in mind as we go along now. All right, so let's say Harrison Company has the following account balances at the end of the year. Accounts receivable is $250,000. The allowance for bad debts is $2,000. The company estimates that 4% of accounts receivable is uncollectible. So remember now, the first thing we want to do is find the target amount in our allowance. So what we're saying is 4% of our accounts receivable is uncollectible. So our target balance is going to be the $250,000 times the 4%. That gives us $10,000. So we need $10,000 in this account. We currently have a credit balance of $2,000. So what does that mean? Hopefully you're thinking, okay, well, we need to credit this account for $8,000 to bring it up from $2,000 to $10,000, right? So our adjustment is going to be for $8,000. So we're going to debit bad debt expense, credit the allowance for $8,000. Okay, so remember what we did. We multiplied the 4% times 250. We found the amount that we wanted in our allowance. We compare that to what's in there, and then we made the adjustment at the end of the year. So when the company prepares its financials, it's going to have this $10,000 as its balance in the allowance at the very end of the year. Okay? All right, now let's say instead that the company had a $1,000 debit balance in the allowance before adjustments. Remember, that means that they wrote off more accounts than they estimated last year. So say we still want the $10,000. We want a $10,000 credit balance, but we have a $1,000 debit balance. All right, so what do? Well, if you have a negative $1,000 and you need to get up to $10,000, you have to credit the account for $11,000. So remember that when you have a debit balance, you have to add these two numbers together to get the amount of your adjustment. So, and if you're not sure, because often students will get tricked with this, if you're not sure, double check. Take your 11 minus your 1, and that gives you 10,000, which is what you want in your account at the end of the year. So the company will debit bad debt expense, credit the allowance for bad debts for $11,000. Oops, sorry, $11,000. Okay? Same entry we had before. Let me go back a second. Exactly same entry, only this time it's going to be $11,000 instead of $8,000. All right, so let's take a look at what an aging of receivables looks like. And here's a simple example. This company only has 6 different customers, or 7 different customers as in their receivables. The aging shows how old the receivable is. So is the receivable brand new? In other words, the customer just bought something from us and they don't even have to pay yet. Is the customer a little bit overdue? It's 31 to 60 days old. Is it 61 to 90 days old, or is it over 90 days? Now, you should be thinking, well, if a customer hasn't paid us and they're over 90 days overdue, meaning that they're 3 months past the time they were supposed to pay us, what happens as time goes on, it becomes less likely that the company is going to collect from these customers, right? So the aging, remember I said, uses more percentages and it's a little more precise. So what an aging does is it multiplies each category by the percentage that the company thinks will not be collected of that age group. Notice that the percentages increase as the receivables get older. So this calculation is going to be the 4245 times 1%, 830 times 2%, etc. And then you add all of these up, and that gives you your target balance. So that 185 is the equivalent of what we had before when we had the 10,000. But instead of having one percentage, we have a whole bunch of percentages. Then the procedure is the same. Compare, this is the number you want, compare that to what you have in your allowance, and make your adjustment at the end of the year. All right, so what we've been looking at is the allowance method, which is GAAP. And that requires estimating the uncollectibles at the end of the period, making the adjustment, and then reporting our receivables at net realizable value, which is the accounts receivable minus the allowance. Remember, that's a contra asset account. There is another method called the direct write-off method. I don't like to spend a lot of time on it because I don't like students to get too confused from one method to the other. But let me just mention it to you so you know what it is. Direct write-off method is not GAAP. The reason is that it doesn't report the receivables at the amount that the company actually thinks it's going to collect. And it only records bad debts when an account becomes uncollectible. So it's not matching. Do you remember the matching principle, which says we should put the expense with the related revenue? All right, that's one of the reasons why we're debiting bad debt expense at the end of the year and making an estimate. So in this case, the bad debt expense would be recorded in periods after the sale. So the direct write-off method is not GAAP. The only time it probably would be used is a case where a company is a small mom and pop business. A company has very few receivables. Maybe they have, an immaterial amount of receivables, or they're on the cash basis, which is often very, very small businesses. So for our purposes, we are using the allowance method to report on financial statements because that's what GAAP is. So to summarize, remember that accounts receivable, of course, is a current asset. The allowance is a contra asset that reduces the receivables on the balance sheet. So if we go back to the example we were working on before, the accounts receivable were $250,000. Our allowance at the end of the period is $10,000, and our net accounts receivable is $240,000. Bad debt expense is an operating expense, and that goes on our income statement. All right, so here I'll leave for a second, or you can pause the video if you're interested in looking at the accounts receivable in a little bit more detail. I have two other videos. This is one of them, and on the next slide is the other one, so you can always come back and look at these, or you can find them on my YouTube channel. The second one is here, and those will give you a little bit more detail and some more examples on using the allowance method. Now let's talk about notes receivable briefly. Remember we mentioned that notes receivable represent amounts owed to the company, but these amounts involve an actual note that's signed, and interest is usually involved. So notes receivable are accounted for at their face value. So when they're recorded in the books, they're recorded at face value. They are also assets with debit balances. Now, notes receivable could be current or non-current. We're going to take a look at a current example. It depends on the due date. So if the note receivable is for 10 years, then of course it would be a long-term note receivable. If it's a note receivable for 30 days, then it would be a current. So of course less than a year as usual. Remember that notes bear interest. This results in the company earning interest revenue or interest income, which has a credit balance just like sales revenue or service revenue. The calculation for interest, simple interest, which you probably learned somewhere along the way, is principal times rate times time. Now, this is the tricky part. The principal is the amount of the note. The interest rate is given to you. That's the interest rate on the note. The time is the thing that gets students sometimes. So be careful. Take your time on the time. Make sure that your denominator here is either 365 days or 360 days if you're in a different class. Sometimes notes are calculated with 360 days. For my students in this particular class, we're using 365 days. Or if it's months, the denominator would be 12 months. Okay? So principal times rate times time, and the time is the part of a year, because interest rates in the United States are, unless you're told otherwise, are given to you annually. So let's look at an example. Say a company receives a 6% 3-month $10,000 note receivable for cash. So basically the company is loaning out $10,000. It's getting a note receivable. It will get repaid the note receivable amount plus interest in 3 months. They're going to debit notes receivable and credit cash. They're both assets. Notes receivable is going up, cash is going down. Now, let's say that the payment on the note is received on the maturity date. Now, by the way, it is possible that a note would not be paid at the maturity date. And if that happens, you'll see that in your guided notes for my students in my online classes. But when that happens, you no longer have a note receivable. Now you have an account receivable for the interest and the principal. But let's say that the payment on the note is received at maturity. So now the company is going to receive the amount of the note, $10,000, plus the amount of interest. So in this case, the total is $10,150. The interest, remember, is the principal, $10,000, times the rate, 6%, times the time. It is a 3-month note, so 3 months out of 12 months is the amount of time. And if you multiply that through, you'll get the 150, and that's the amount of the interest. Now, this could be a little bit more complicated, so you're going to look at some other examples. If you have to accrue interest at the end of the year, or if you have a situation where the note is dishonored. There is another note receivable video. I thought these QR codes might be helpful so that you can go right to those other videos. So you could pause this, or you can again find that on my YouTube channel. That goes into the notes receivable, both notes receivable and notes payable, in a little bit more detail because they're mirror images of each other. All right, so that's all we have. I hope this is helpful to you. I will see you in the next video. Happy studying.